Hello, this is Mark Sobel, U.S. Chair OMFIF. Today, I'm honored and delighted to be joined by Don Kohn and Dennis Lockhart to discuss the latest FOMC and the monetary policy outlook. Donald Kohn is formerly a 40-year veteran of the Federal Reserve, capping his career as Vice Chair of the Board of Governors from 2002 to 2010. He also served as an external member of the Financial Policy Committee at the Bank of England from 2011 to 2021. He's now at the Brookings Institution. On a personal note, I had the pleasure of interacting with Don a bit during my Treasury days, and apart from being one of America's most distinguished monetary policy authorities, he was always one of the most liked and absolutely finest colleagues.
Thank you.
Dennis Lockhart was president of the Federal Reserve Bank of Atlanta between 2007 and 2017. Before that, he had an extensive career in finance and academia, and he's now currently a distinguished professor in the Sam Nunn School of International Affairs at Georgia Tech, where I had the fortune to visit earlier this year, thanks to Dennis. And as someone who spent a good chunk of his childhood in the Southeast, I learned that there's more to Atlanta than at Hartsfield Airport. So I plan to ask Don and Dennis several questions to get the ball rolling for the first half of the session and then turn to audience questions. Questions can be submitted via the chat or Slido function. So Dennis and Don, thanks for joining me.
Great to be with you, Mark.
Yeah, likewise, Mark.
Okay, well, let's start with a high-level brief question. So the run-up to this FOMC had seen a wide dispersion of views among FOMC participants. The markets, in the end, were widely expecting a cut. So what's your broad high-level take on where the FOMC landed, the statement, the presser, and the dot plot? And then after that, we're going to drill down into details. So Dennis, why don't you start us off?
Well, I think the characterization of the meeting as and the results of the meeting as being a hawkish cut is accurate. I would say mildly hawkish in the sense that I picked up vibes that there probably will not be cuts in the near term. The presser, Jay Powell, several times mentioned that a policy is well positioned to wait and see, and I think that gives us some indication of current thinking. The statement itself tweaks some language from additional adjustments to the target range, which was October, which sounds pretty certain to the extent and timing of additional adjustments, which sounds to me more tentative. So my interpretation of the meeting and the communication around the meeting is that they will take a pause here at the beginning of the year. Others have different views, but that's what I took away.
Thank you, Don.
I largely agree with Dennis with a little bit of a tilt here. So I think they did what people expected them to do. And with the cut and with the sense that a pause is very much possible. And he reinforced that pause feeling with the extent and timing, as Dennis said, the change in the announcement language, but also by saying we have gotten our rate roughly into a range around neutral, and that's the right place to be when you have risks on both sides. So the risk that the unemployment rate could rise and the risk that inflation might not fall, being roughly balanced, you ought to be at neutral. So I thought he actually did a better job than he had in the past of explaining the so-called balanced approach to these risks, and that hinted at and as Dennis said, I mean, he said we've cut 75 basis points, we're in a good place, we can wait and see. But I thought the press conference had a somewhat more dovish, as they say, tilt than I think Dennis was getting. He seemed very confident that inflation was headed for 2. He said, we subtract the tariffs and we're down in the low 2s already. Labor market is softening. That's going to reinforce that downward thing. He even referenced that service inflation there was service disinflation. I'm not sure I could see that, but he said that, and so he seemed much more confident that the economy was on its rate to two than he did about the labor market. He kept talking about softness. He noted the rise in the unemployment rate. He did this subtracting 60,000 from the establishment survey, that adjustment, which gave you negative. That was a bigger adjustment. That was twice the size that Goldman was adjusting it, for example. So he seemed to emphasize and worry about the weakness in the labor market more than he was worried about inflation not getting back to their target. So I agree that they've given themselves scope. The hurdle for moving further is much higher than it was. And they've given themselves scope to pause, particularly with raising questions about the information that they'll get between now and January and how it might be distorted by the government shutdown. But I think, at least in Jay Powell's mind, rates are more likely to fall than rise. In fact, he said that the debate was about keeping rates where they were or reducing them, and he seemed to gloss over the fact that six members of his participants, not members of the committee, but participants, really didn't want to reduce rates. So, but I thought it had a little more of a dovish tilt, and that's where the markets, I think, picked up. That's what they picked up.
Mark, Don mentioned the summary of economic projections, and I think it's important to look at that, even though at the beginning of a year, that is the December SEPs, in my mind, it's much more conjecture because you're putting dots at the end of the next year. Nonetheless, if you look at the array, Don mentioned the 6 so-called silent descents. Probably 2 of those 6 were real descents, and 7, I think 7 wanted no change in 2026. 11 of the dots were for 1 cut or fewer. To me, that's the body language or the mindset of the committee going into the year. That suggests to me that there's some patience.
Okay, well, all right. So that is your interpretation. So now let me try and smoke both of you out a little bit more provocatively. So economists frequently assume mean reversion in their forecasts. And so the dot plot shows inflation returning to the Fed's 2% target. Growth is a potential, but inflation has been creeping up. To me, it seems lodged more closely to 3 than 2. Labor markets are softening, but the unemployment rate isn't rising sharply due to the impact of reduced immigration. And the dot plot has unemployment basically unchanged to down next year. Growth is holding up. The 26 outlook in the dot plot was for higher growth. Maybe some of that's just borrowed from the fourth quarter. Monetary policy operates through financial conditions. Those are accommodative according to the indices. Inflation expectations, New York Fed at 3%. So it's obviously a balancing act, as Don was highlighting, but was the case for cutting rates all that sound? And obviously, we'll have to see how the data shake out. But do you believe, as opposed to what Powell was suggesting, do you believe rates should be on hold for a good bit? So, Don.
Yes, I do, Mark. I think I would like to see some material progress on that inflation picture. So I think you can make the case. I mean, I agree with the idea that tariff price increases are a price level increase and not necessarily inflation if they don't get built into expectations. You cited the New York Fed expectations, but if you look in the market-based expectations for CPI on the swaps, or if you look at the difference between nominal and real treasuries, the market has inflation going back to target in 2027. And basically, that's what Jay Powell was saying. So I think expectations seem pretty well anchored. It's okay to look through it. Um, there are estimates of what the tariffs are worth of about zero point 0.5, which I think he cited, if not at this conference, the previous press conference. St. Louis Fed has some estimates, and there are other estimates sitting around. So that might suggest, but boy, they've been above their target for since 2021, and I think it's. I think I'd like to see a slightly restrictive policy kept in place in order to get better assurance that inflation's coming down. And I think the labor market is weakening. The unemployment rate has crept up, so it looks like demand is a little bit softer than supply. But the most recent initial claims for unemployment insurance haven't gone up. Vacancies are up a little bit. Yes, hires are down. So it looks like kind of a stable labor market. And we'll get a lot of information there. So I think if I were a member of the committee, I'd be prepared to pause for a while just to get some better assurance that I was going to hit my inflation target. Jay Powell at Jackson Hole shifted his emphasis from inflation to labor markets. And he said there, we do not want any more weakness in labor markets. And he's acting on that. But now they've acted on that. There have been 3 cuts since Jackson Hole. So I do think it's time to wait and get confirmation that that inflation rate is going to come down to the target for the first time in 4 or 5 years.
Can I put just one follow-up to you then, Don? As an independent not analyst, not thinking about all your former Fed past and you being the vice chair, if you were just an independent analyst looking at all the data going into yesterday's meeting, where would your dot have been?
I think it would have been for no change. It was a close call, as a lot of people have said. And it would have been nice to have some real data. We had the ADP negative data on the labor market, et cetera. So I think I would have gone in to the week before the meeting thinking close call. I'd prefer to keep it where it is, but I would have been persuadable at the meeting if people had come up with some really strong reasons why they thought. And I don't, what he's looking at data or analysis of these inflation data that are giving him confidence. And I'd like to see that. I think what's missing from the debate between the hawks and the doves here is some finer analytic and empirical information. So the hawks are saying there's this risk that inflation won't come down. I wouldn't have, they one of them wouldn't have voted for the previous cut in October. What's he looking at? What indexes are he looking at? What's Jay Powell looking at? How did he arrive at that stuff? So how did the board staff come up with this minus 60 on the thing? So I think we're in a position. I'd be interested in Dennis's take on this, in which people seem to be asserting their concerns about this risk and that risk with uh, less analytic backstop to it than I would like to see. What do you think, Dennis?
Well, I'll mention that because of the government shutdown and the lack of data, I suspect many of the Fed presidents had many, many conversations in their districts with frontline business people and asked them questions about what are you doing about pricing, for example, and other normal questions about demand and such. And I suspect that many of them heard the tariff story is not over. We're going to see more effect on prices in 2026. And so the presidents may have come to the table, some of the presidents come to the table a little bit dubious about the base case assumption that it's a one-time effect and it's just not going to result in something more persistent. So I think a constituency developed on the committee over the last couple of meetings that says, look, we really have to give attention to and some priority to inflation. It may not just be a simple pass through. And we have, after all, been stuck around 3% for quite some time and have missed our target for almost 5 years. I think that that sentiment is building, and the anecdotal stuff may have weighed more heavily in the assessment of some of the presidents.
That's an interesting point. And your former your former home, the Atlanta Fed, publishes a sticky price index, and which should capture services basically. That's stuck at 3 or over 3. I think 3.5. It's been a little while since I looked at it, but I think it's been stuck at around 3.5, which is the services are always going to be running a little higher than the goods part of the CPI. But 3.5 is too high, so it hasn't shown any tendency to come down of late. So that reinforces your point. One of the points that I've heard made is that January is a big deal for pricing, that a lot of businesses get through the holiday season, they get through the end of the year, and then they reprice in January. So perhaps the presidents were hearing, we're going to have a big repricing in January. So I think looking at that January CPI and maybe the February CPI will be, and PCE indexes will be important for gauging the inflation picture going forward.
Another reason, and I'd be interested in your opinion, Don, that we may be looking at least a near-term pause is because the first quarter is often anomalous relative to the full year. And often we get, because of seasonal residual seasonality and real economy effects from weather and so forth, we get readings in the first quarter that don't really give you a sense of how the economy is actually evolving. And that, to me, when I was there, I always suggested in the beginning of the year, I'd be a little more cautious about policy action.
Yeah, that's a good point. It's just hard to seasonally adjust around all those snowstorms and other anomalous seasonal things. I think we should point out, Dennis, you highlighted the whole picture that comes through the SEP, not just the dots. And that's a very positive picture in which they revised up their growth forecasts. So, and revised down a little bit the inflation forecast. So it really was from their lips to God's ear, it really was a very, very positive thing for welfare. But there are reasons to think that the economy is going to pick up. I mean, they have it picking up. Some of it, as Mark said, is pushing stuff from Q4 to Q1 because of the shutdown. But there's more to it than that. You have, Dennis, you mentioned the financial conditions, or maybe it was Mark, are easing, and that's going to push things up. You've got checks being sent out and lots of things from the big, beautiful bill cutting in the first and second quarters. That'll push up growth. We saw the small business survey show a slight uptick in business optimism. The tariff uncertainty is gradually declining as more and more of these agreements are reached. So I think there's every reason to think the economy will pick up. Now, some of that could be on the supply side. Some of that could be a productivity increase. And there was a little discussion of that in the press conference too. But I think it's also on the demand side. And the FOMC itself has demand expanding faster than supply. It's got the unemployment rate gradually, very gradually coming down. But you could make a case that that pickup in demand is going to be even larger than they have built in, which would be another reason to pause and see just whether that begins to put some real underlying pressure on prices and interferes with that.
So you guys are great. I can just sit back and let the two of you dialogue. I'm having you back again. Dennis, where would your dot have been? And I think you've already said this, but you think the Fed should be on hold.
Yeah, I do for the near term at least. It's always depending on how the data come in. I would be similar to Don. I would have been persuadable that 3 cuts amounted to a nice structure of support under the labor market, and then attention to inflation would be appropriate in the coming meetings. I probably, however, would have gone in on the Wednesday or Thursday before with no cut, but my experience was that 125 basis point cut one way or the other is maybe not all that material, and showing some solidarity was important. So I probably would have voted for the 25 basis points.
Okay. So
And there's an important point there, and that is sometimes what people say in the meeting and what they show in what they actually vote for is not exactly the same thing.
Yeah. That was why I prefaced my question to Don about if you were an independent person and not, a good member, loyal member supporting the chair. So we've seen a greater dispersion of views. We saw the 6 dots for unchanged. We've saw 2 dissents one way, 1 dissent the other. So there seems to be, as I said, more dispersion. Don, I noticed the Bank of England, there's quite a few dissents over time. Are dissents good or bad?
I think they're good in the circumstance like right now. So I think you have to, and by that I mean, as Jay Powell keeps saying, the goals are in tension. It's not, while their expectation is both goals will be met over the next couple of years, they haven't been met yet. The inflation's too high and labor market looks like it's softening and maybe softening more than is required. So the goals are in tension, and I think it's natural and really to be expected, but also encouraged that you have people putting different emphasis on these different goals and have different ways of looking at this. So I think the idea that you have to have a consensus at every meeting is, they should drive towards consensus. I get that. It strengthens the message coming out of the committee, but I think the drive has been too strong. It's disappointing to me that there were no dissents in the fall of 2021. I mean, there were people saying, you guys need to get going. This, the median forecast of private forecasters was inflation's coming down in 2022. This is transitory, but there were alternative views being expressed. And there were people worried about the effects of fiscal policy, the Biden fiscal policy on demand and inflation. And it was disappointing to me that there weren't any dissents then. So I think some dissents are fine. If they get to be too many, then I think the risk is that you could flip quickly from one thing to another, and you will create uncertainty. Now, I have to say, Mark, I made this point to Mervyn King back there in the late 90s or early 2000s when the Bank of England was just getting going with its monetary policy committee about creating uncertainty with all these dissents. And he sent me some empirical evidence saying, no, there wasn't any effect on volatility in markets or spreads of options prices and things like that when there were dissents. And in fact, he himself, as the governor, dissented a couple times, I think. So he voted with the minority on the Monetary Policy Committee. So maybe my concern about volatility and uncertainty is too much, but I do think it's good to have uh, a consensus, a rough consensus about where you're going and the story you're telling. But I also think it's good, particularly in tough moments, to have dissents and make sure the public should know and should be more confident in the Fed's decision if it's aware that there are different views being expressed and being expressed strongly enough to draw dissents.
Dennis, how do you see it?
I agree with Don substantially. 3 dissents is unusual. It only happened once in the 10 years I was there, as I recall, but it in this particular case does not indicate a fractured committee, really, and I think it's healthy to have dissents, particularly when the policy decision is such a close call as we have characterized it at the last meeting. I would get worried if it were 7-5 and the 5 were all on the same side. That to me would, I think, give some pause because, as Don pointed out, that could flip very easily from meeting to meeting, and you could have a very erratic path of policy. That's not a good thing. I would also say, with all due respect to the Bank of England and pound sterling, I think the dollar is simply more a point of attention on the part of capital markets around the world. And so showing a reasonable consensus is important, I think, to the stability of the dollar and the attitude toward dollar investment and so forth. But having said all that, I don't think we should overreact to 3 dissents.
Right. Dennis, are you concerned at all that you seem to have governors on one side and presidents on the other? Now, traditionally, over time, the presidents always have been a bit more hawkish than the governors, who are closer to the politics, but this seems to be accentuated. It actually would be nice to see more variation in both, so it doesn't look like governors versus presidents, political appointees versus both birth versus not.
Well, the history that I experienced, Don, is that the governors rallied around the chair, and there was practically never a dissent to come out of the governors, and all the dissents came from the presidents, who are simply a bit more free, and they're not part of the leadership group, the internal leadership group within the committee, which I presume has enough discussion prior to the meeting to have formed a consensus of desired direction to go. This is unusual because one of the dissents is from a governor, but it is a very special case, it strikes me. I do think the presidents, to some degree, almost inevitably reflect the sentiment of their districts. And so you end up with some very, very conservative, inflation-oriented districts. Kansas City might be a good example, that are simply more predictably going to dissent around the trade-off between favoring employment versus inflation.
Now, I would note that this governor's president's thing is fairly new. If I think about history, if I think back to the 80s under Volcker and early Greenspan, I think there were governors dissenting on a pretty regular basis in those things.
So I have 2 more big questions, and then the audience seems to be rolling in with questions. You guys are in hot demand. So the first biggish question relates to the Fed, quantitative tightening, the balance sheet, money markets. We saw some tightness in the money markets. in moving from abundant to ample reserves. The chair said we were at an ample reserve now, and basically said that the Fed would resume buying short-term treasury bills only for operational reasons, not for monetary policy reasons. Some people have said no, this is the start of QE. How do you so let me start with Dennis on this one. How do you see that nexus of issues?
Well, the overnight repo rate has traded in the market for repos above the top end of the Fed funds rate range a little bit in the last few weeks, and has traded out of the desired range in which the committee wants it, and therefore it does seem to reflect some landing in a period in an area of adequate reserves, but conceivably with some illiquidity. You're looking at year end, and then later looking at the April 15th tax day, when there has historically been some market volatility and illiquidity. So I take it at face value that, as Jay Powell characterized it, this is not QE. This is temporary reserve management to just add some liquidity to the market, and it's focused on bills, 40 billion a month, and that will probably end in April or May. So I take that at face value, and I don't think you can interpret it as quantitative easing all over again.
So Don, the same question to you, and just to amplify, my former colleague, friend, we all know him and adore him, Dick Berners, wrote in a question. The reserve management purchases are aimed at rate control. Will those purchases hit the target? Could there be other ways of addressing the issue? So my question and Dick's question to you.
So I agree with Dennis. I think this is not QE. It is reserve management. As the chairman explained, the demand for reserves is going to rise with activity, with GDP, with the flow through banks. They always said they were going to stop short of that bend point in the demand for reserves. And I think what they found is they got to the bend point, or got uncomfortably close to the bend point, and now they're moving away with this. And it really has nothing to do with fiscal dominance or with easing monetary policy, except for a few basis points on repo and so forth. I think one of the so I agree with what they're doing. I think partly this is they set up a repo facility in order to cap the repo rate, and it's not working. So it's working. They're getting some activity there, but not enough activity to really cap it. And that's a shame. I think the problem, and I've heard market participants talk about this, is there's still stigma in borrowing from the Federal Reserve. And how often have I heard people, starting in 2009, to the late 2008, 2009, but I heard it as recently as 4 or 5 weeks ago, money managers saying, my boss told me that if our bank borrowed from the Federal Reserve and he was called down to Washington to testify about why he was taking money from the government, I was fired. So I think they haven't overcome the stigma problem, and I would expect. I hope they continue to work on it. One way would be to try and not cast the SRF, this repo facility, as a discount window thing, but cast it as an aspect of open market operations, really. And they've changed it. They made it a standing facility. There's things they could do, central clearing and things. They might even lower the rate a little bit and make it closer to the funds rate target. But so it would be great if they worked on that. Dick asked what else they could do. I think working on that. And the other thing would be temporary open market operations. So if you expect something at window dressing at year end, particularly by foreign banks, puts pressure on repo, just do something over the end of the year. That's what we used to do in the old days. So I think they have other tools they can use. The reserve management operations should gradually build up the reserves sort of on a more permanent basis, but there are ways of capping it, of putting temporary reserves, and they ought to be exploring those as well.
Okay. Do you have any major comments on that, Dennis, or should I move on to the next question?
I think in the interest of time, let's move on and see what
All
the
right.
audience is interested in.
Good. Well, my last question, let me start with Don on this one, but it involves supervision and regulation. So, ahead of the global financial crisis, the mindset was light touch regulation. I felt looking back at the GFC and that the supervisors didn't understand structured products or the leverage and risk building up in the system. After the GFC, there was this potent response on capital, liquidity, and leverage standards. We knew some activity would go to the non-banks, but now, tweaking ESLR, no big deal, I guess, in my mind. But one also reads about efforts underway for substantial bank capital easing. One reads about the intention to cut the sup and reg staff at the Fed by a third. We've gone through SVB, we've gone through Archegos. Just as somebody who used to dabble a little bit in these areas because of my FSB responsibilities, is the Fed being too lax in forgetting the lessons of the global financial crisis? So Don.
So I think it's too soon to tell, but I'm worried. So it's a little hard to know how all this stuff is going to add up, but I do get concerned. We don't know what they're going to propose for sort of regular capital requirements, but I do worry that I think, to me, the global financial crisis, the problems there was not only the regulators who didn't understand structured products, but the people who were buying them didn't understand the structured products. How many bank president, CEO said, I had these things, they were AAA, but they didn't understand it was a structured project, go from AAA to single B and C overnight, and people start defaulting. So no one really, not at least a lot of people, didn't understand structured products. And there was a lack of confidence in the banking system and the financial system once this started to break, and with the shadow banking system too. So it's quite possible that things overreacted in one direction. It's natural for them to pendulum to swing back, and then to let's sort of recenter it. Let's see where we should be here. I think the things that worry me are, if they're going to cut back on the capital requirements, I want to see good stress tests. That's the ultimate test. I've cut the capital requirements. Banks are lending more. Are they resilient to a severe stress situation? So when such a situation occurs, they won't make it worse. They won't make the business cycle worse. And so I think the stress tests, both the liquidity and capital stress tests, are so important. And I hope that I get the thing about more transparency, et cetera, but I hope they don't end up weakening that. And the same thing I might say about the supervisors. So I think it's probably the case that the supervisors were too focused on process and not enough on the actual risks. But if you start lowering liquidity and capital requirements, if you weaken the stress test, and then you take out the human possibility and all this reduction in staff, it's the experienced people that are leaving. They're the ones that are taking the early retirement. They're the experienced ones that have probably offers from the consulting world where they can go, and so you you might be left with a bunch of bright people, but they don't have the institutional memory. So I get concerned that okay, rejigger things, but let's make sure that it's still resilient to a difficult situation, and the banking and shadow banking systems don't amplify a cycle. And we're in the upper part. We've been growing since coming out of COVID. This is a time when euphoria takes hold. We can see it in asset markets, Dennis mentioned, and it's probably true on banks too. So this is not a time to let up on the testing of the resilience of the system.
Okay. Dennis, please.
Yeah, I don't have much to add. I'm a former regulatee and a former regulator, and I have always felt that the objective should be to strike a balance that works for the industry, in this case, the banking industry, and at the same time protects the public as much as possible. Unfortunately, I think the way the world works is a pendulum that Don referred to. We went one direction very, very strongly in 2008 and 2009. And gradually that pendulum has been swinging back, and it's likely to swing too far. So I'll sort of end this monologue with one of the more profound things that I picked up on when I was at the Fed was the work of Hyman Minsky and the Minsky moment. And are we headed to another Minsky moment? Because as you go through the years of nothing terrible happening, leverage increases, risk-taking increases, risk in the system builds up. So I have to be a little bit concerned that the pendulum will go too far.
Okay, well, let's turn to some audience questions. So Dennis, is the effect the shutdown had on data availability and quality for forecasts a short-term effect, or does it have longer consequences?
Well, I think it's a short-term effect that is not corrected immediately. It takes some time for catch-up and for some massaging of past data. Therefore, I think to some degree the committee is a little bit more in the dark of what's really happening right now, and it will ease as we go through the first quarter and we get back onto the cycle of particularly government data coming out. During the shutdown, and there was a reliance on private sector data, and as I referred to earlier, on the part of some committee members, probably some reliance on their real-time soundings in their districts of what they were hearing from people. Now we'll, over the first quarter, get back to more of a normal approach, I think, of data dependence.
Don, anything to add?
No.
Okay. All right. There's this guy that we all know named Steve Kamen. I write articles with him on occasion. And he's asked, how should the Fed be factoring in the effects of the fall in immigration? Should it be tighter in response to a potentially sustained supply shock? Any volunteers?
Well, I attended something last week where a former Commerce Department official who was very familiar with the data collection spoke, and the basic message was immigration policy is distorting labor market data, and we don't yet know fully how those distortions actually are being reflected in the numbers. I found that to be a very interesting thesis, and I would say that what's going on with deportations and immigration and the effect on the supply of labor, really the slowing of the growth of the workforce, is simply an unusual situation that we haven't seen in the past, and it's a little bit harder to evaluate what the real employment situation is.
So I agree with Dennis. What the Fed should be focused on is the balance of demand and supply. So it's maximum employment consistent with price stability. And it's hard to know what that is if you don't know what the supply is. So we actually faced this in the Biden years, right? So I remember coming to a CBO meeting a couple years ago and CBO saying, there are about 2 million more people in the labor force than census or BLS is allowing for. And that explains a lot of the data we were getting coming out, that all these people coming in. So I think both the Biden immigration policies distorted the data, and now not distorted, affected the data, and now the other does. And it's really interestingly, this CBO thing, which they later published and coincided with some work some of my Brookings colleagues were doing on what the working population really was. It took a while to figure that out. And I think it'll take a while to figure out what the clampdown on immigration is doing. Another aspect of that is, of course, they seem to be clamping down on legal immigration and changing the skill mix of the immigration, this might affect the level of the unemployment rate consistent with full employment. So I think it's creating a lot of uncertainty. I think Jay Powell's been absolutely right to emphasize that both supply and demand are shifting down, and it's his job or the Fed's job to figure out which one is shifting by more, and it's very hard under the circumstances because of the factors that Dennis was citing.
Okay, well, here's a question I really like. I think I'm going to go with Don first on this one. It's from John Murray, who we all know from Bank of Canada and now Ontario Teachers Pension Plan. Should macroprudential considerations be factored into interest rate decisions, specifically leaning against suspected asset price bubbles?
I've got a long history of being opposed to that, being suspicious about that, and thinking that the cost of leaning against the wind, which is what John's talking about, can be very high. It means you're tolerating higher unemployment and potential misses on your inflation target underneath the inflation. It's not really an issue right now. Now, if you thought, I think John's raising this at an interesting time. I was just thinking as John's question came up, if you thought that the regulatory authorities weren't really alert to looming systemic problems, would that change the view? Because in my mind, it's much better that you lean against these what Dennis was talking about, the euphoria that occurs at the top of the cycle, with regulation rather than monetary policy. But if you thought regulation wasn't doing it and you really could identify a risk, I think I'd have to think maybe a little harder about this. And I'll give you an example. In December of 24, when the Fed cut, the stock market was on fire coming out of the Trump election victory, because they could see the deregulation and the tax cuts that were coming. And I thought, boy, I wouldn't be pouring gasoline on that fire right now. And that was financial stability consideration. So while while I've argued with a lot of people that shouldn't come into monetary policy, I must say it does every once in a while. Maybe there's no alternative. If you think there's a real threat to financial stability, when the market when things turn unstable, people will look at the Fed and say it's your fault. Doesn't matter whose fault it is. They'll say to the Fed, it's your fault. So Jeremy Stein famously said, raising interest rates gets in all the cracks, all the stuff that isn't regulated. I've argued with him on several occasions on this, but I think in my old age, I should back off my certainty here.
How does the youngster Dennis see it?
Yeah. Well, I would never say never, but as a general rule, I think the focus should remain on the real economy. Now, asset bubbles risk real economy effects. But having said that, I learned over the years I was at the Fed that getting too involved in a minuet with the markets was really not a good place to be from the Fed's point of view, and that they should keep their focus on the prosperity of the real economy and let markets be markets for the most part. One person's bubble is another person's fully priced market. And, really determining that it's time to intervene is an extremely difficult thing to do. And as a practical matter, very difficult in committee to get a consensus around.
Okay. So we're beginning to come to the end. I have two more questions. The first, let me throw Dennis's way. It's about stable coins. I think the Secretary of the Treasury sees them as boosting demand for treasuries, as reinforcing the dollar's globally systemic role. I'm not sure I see where the additionality is per se, or that this is going to be all that he does. But how do you feel about stable coins and some of these issues? Dennis.
Yeah, well, thanks for the question. Let me just say, when I retired, I thought I'd never have to utter a disclaimer again. Now I have to utter a disclaimer. I'm on the board of PayPal Digital, which is PayPal's New York trust bank focused on cryptocurrencies, blockchain, and very importantly, stablecoin. So I'm not speaking for PayPal or PayPal Digital. There's my disclaimer. It's, I think, an interesting dichotomy has developed between naturally central bankers and people who are interested in financial stability, looking at the crypto phenomenon in one way, and those people who are in the trenches of trying to build up particularly stable coin, looking at it differently. Here's my take. Stable coin is a payments device. It is a wrapper on a fiat currency. It's not a distinct reserve asset and will not be. It's simply a digital twin for payments purposes of the fiat dollar in this particular case. The stable coins in the world are dominated at the moment by dollars. You can debate whether it's a good or bad development, but let me just say, from my perspective, it's coming. And the use case for payments is a very compelling use case. And so I think regulators or people in the camp that this is a concern, I think should start with the idea that this is coming. So let's get used to it and figure out how to make sure it's done in a responsible way.
Don.
So I agree with Dennis. It's much, particularly for international transfers, right, Dennis? It's much less expensive than the way transfers are made today. For small transfers, remittances, and also for large payments.
It's
So
it's cheaper 24/7 instantaneous settlement, virtually instantaneous settlement. So it really has a strong use case versus the legacy payments rails of the banks.
So I think the one challenge is making sure stable coins are stable. And the Genius Act tried to do that. It said you can have deposits in insured institutions. It didn't say insured deposits. So I worry about a situation in which the way we had in March of 2023 with Silicon Valley Bank, with a bunch of uninsured deposits backing stable coins, some banks in trouble that have issued those uninsured deposits, and then the pressure on the authorities, as it was true in March of 2023, to extend the insurance to everybody. And I those ad hoc kinds of decisions, and I was part of a similar decision in October of 2008. So I made it myself. They're very hard to make, but you shouldn't be designing systems that ex ante lend themselves to that kind of pressure. So I do worry about that. There's about the stability of the stable coins. Lived through too much money market fund runs for that to be complacent about that. And then there's the issue of paying interest. So the Genius Act says you can't pay interest, but I don't know whether Dennis's group is doing this, but others are finding a way around that by giving rewards. And then whether those stable coins become more than a payments interest, but they become a store of value because they'll be yielding rewards of some sort. And I think we need to analyze that and figure out how that's going to work and what effects that will have.
So we could probably go on for a long time on this one. But I wanted to, in like the 3 remaining minutes, just put a motherhood and apple pie somewhat question to you. But I mean, we all support Fed independence. That means an accountability framework, but the Fed has independent control of setting in short-term rates and managing its balance sheets within that accountability framework. The president seems to have different views. He has said he wants low interest rates, in part to help provide cheap financing for the government. So, how worried are you that pressures could emerge because of our large debt to provide cheap financing for the government? Or alternatively put, how worried are you about fiscal dominance? I'll let the two of you decide who wants to go first on that one.
Well, I'll chime in with just
Great.
a couple comments.
Great.
I'm very concerned about fiscal dominance because the fiscal side of our financial affairs in the country, it's hard to be anything but pessimistic. There's no political will to address it. The trends, both debt and deficit, are going in the wrong direction, and it's there's no clear turning point in the future, and how this gets resolved in the longer term really remains to be seen. So I think it's foolhardy not to be somewhat concerned that we're headed to some kind of resolution that is going to be very painful. And Fed independence is part of that picture, it seems to me, and the erosion of that independence, if that either continues or happens, is simply, as was said in the conference I attended, termites under the structure that are eating away, but you don't necessarily pay attention to them.
Well, I think I'm very worried about the Fed independence side of it, and I think we see the termites. They post on Truth Social every day, so I think that'll get me some threats, won't it? I think the president, this fiscal dominance I think can be resisted for a very long time as long as you have an independent monetary authority. And that will impose some discipline on the fiscal authorities because interest rates will go up. And if you erode the independence of the Federal Reserve by giving the president a much freer hand to fire people for cause, if you down, if in the Lisa Cook situation, if you define cause down to a parking ticket 10 years ago, you're in trouble. If you put people into the institution whose main job is to see their main job as to please the president and elect people from that party, you're in trouble. We saw that with Arthur Burns, right? So a counselor to the president put in who wanted the president to be successful and didn't lean against the emerging inflation, and we had a decade of inflation. So I thought that should have taught everybody a lesson that you needed an independent Federal Reserve, but that lesson hasn't been entirely learned by the current denizen of the White House, and I worry about what that might imply.
Well, thank you. Termites on Truth Social. You're going to become a headline writer with quips like that. But well, let's wrap up. I want to thank Dennis and Don. Tremendous thanks. This was a wonderfully free-flowing discussion. We touched on the major issues. You provided very insightful and informative analysis, good education for me. So tremendous thanks to Dennis Lockhart and Don Kohn. I wish everybody, thanks to the audience and thanks for the questions. And I wish everybody a good day wherever you are. Thank you.
Thank you. Good to see you, Dennis.
Likewise, Don.